Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Paused for now. President Trump says he's calling off a planned strike on Iran, citing appeals from Persian Gulf allies. But he warns the U.S. remains prepared to attack if a deal is not reached. Oil and stocks decline after Trump's comments. Investors worries about lack of progress in Iran, keeping inflation concerns front and center. And Nvidia CEO Jensen Huang says China could eventually reopen its market to U.S.-made AI chips, signaling a possible thaw in tech trade tensions. It's just gone 8 a.m. across the Emirates, 5 a.m. over here in the UK. I'm Joanna Bersecci in London today and this week. Building up on the big news overnight and the fact that President Trump has decided to hold off on further attacks on Iran, at least for the time being, no imminent attacks. And he says that's at the request of Persian Gulf countries. Let's also see how markets are reacting to this fairly consequential geopolitical news. Inflation once again front and center. Abir Abu Ahmad is in our Dubai studio. Abir, just walk us through how investors have reacted to this bombshell announcement from President Trump overnight.
Good morning, Jumana. So like you mentioned, President Trump is holding off an attack from in Iran after speaking to Persian Gulf officials. He said he spoke to the rulers of the United Arab Emirates, Qatar and Saudi Arabia, and they held him off from attacking imminently Iran. Now, how markets are reacting, what we're seeing in U.S. futures is they're down 0.2%. This is after a flat close in the S&P 500 yesterday. Something else that's quite interesting in the U.S., perhaps not very relevant to the war, is something that our colleague Anthony Stevens pointed out earlier, which is this rotation that we're seeing outside of semis and into software. Now, since the start of the year, software stocks have not been doing very well. Hardware stocks, on the other hand, have been outperforming. So we're seeing a rotation from one to the other, a trend that he pointed out that I thought was quite interesting. What we're seeing in Asia this morning is 0.6% on the downside. And this is, again, as investors take cash and don't pile their money into stocks, because we just don't know what is happening in the Middle East and whether a truce is achievable at this point. So a sense of jitters is coming across markets in Asia. Brent crude prices, as a reaction of President Trump's comments, 1.9% lower. It is at $110 a barrel this morning, Jumana. And then when we talk about bonds, now we saw what happened with the bond markets yesterday, especially in Japanese yields and those decade high yields. U.S. Treasury bonds not doing much this morning, 1 basis point higher for the yield on the 10-year notes. Now we flip the board, and this is an interesting chart that I saw today, and this is relevant to Japan. The yields on the 30-year notes and the 10-year notes accelerated to the highest levels in decades. Data that came out this morning, Jumana, about Japan's gross domestic product suggested that for the first quarter, it was higher by 2.1%. Now, this is much higher than consensus of 1.7%, and perhaps giving the BOJ more reasons to hike rates. Now, we keep an eye on the yields in Japan, again, decades high, as you can see in the chart, but also we keep an eye on the yen and those comments from Prime Minister Sanai Takaichi about whether fiscal stimulus or some economic packages are warranted now with the impact of inflationary risks coming out of the region. But that is what we're keeping an eye on. So bonds, markets, and Brent all in focus this morning, Jumana.
Yeah, the triple Bs, Abir Abu Ahmad in Dubai. Thank you so much. Well, President Trump says he has called off strikes on Iran, scheduled for later today. That is after Gulf allies asked for more time to seek a diplomatic resolution. Trump says the U.S. remains prepared to attack if an acceptable deal is not reached, but did not give a deadline.
I was asked by Saudi Arabia, Qatar, UAE, and some others if we could put it off for 2 or 3 days, a short period of time, because they think that they are getting very close to making a deal. And if we can do that where there's no nuclear weapon going into the hands of Iran, I think, and if they're satisfied, we will be probably satisfied also.
Well, let's stay in Dubai now and speak to Stuart Livingston-Wallace, Bloomberg's executive editor for Middle East, North Africa and Russia. Stuart, well, yesterday we were having a discussion about what the U.S.'s options are and whether they actually do end up going down the military route. It seems now, from what President Trump has actually told us, that they were very close to launching a renewed round of attacks on Iran, but held off because Persian Gulf allies restrained them. Does this mean that there's a potential for a breakthrough on a deal in the next few days?
Good morning, Jemana. So, I think you need to apply a certain level of skepticism to the Truth Social posts because, as you know, they're frequent, they're often, they need to be treated with a degree of caution. However, it must be said that it did feel like there were fewer and fewer options here. Iran seemed like it was totally unbending on the key issues as far as the US is concerned, and at the same time the US was unwilling to compromise on what it sees as the red lines. So on that basis, maybe we are getting closer to a deal. I have to say there is very little visibility on where exactly that might be and where are the common grounds here. But clear, I think, from a regional perspective, that a diplomatic option remains the preferred option over a kinetic one.
Yeah. And Stuart, I think what's also become apparent, and again, there are a flood of headlines coming through from various Iranian state media outlets and so forth, but is it fair to assume that for the diplomacy angle to proceed, there also needs to be an understanding of what the framework is for discussions as opposed to an actual deal breakthrough, and that it seems as though Iran had been wanting to separate the issue of the Strait from the nuclear option. The US want to combine the two issues together.
Yeah, agreed. But I think there's a fundamental problem here. So I'm going to point to one example. The US produced a one-page memo, I recall, a couple of weeks ago, that was supposed to be the framework. And I think you look at the complexity of trying to resolve the long-standing multi-decade issues between the US and the Islamic Republic, and secondarily between the Islamic Republic and Israel, and then thirdly between the Islamic Republic and the Persian Gulf, and to try and distill that into a single-page memo feels absolutely extraordinary. It is so simplistic that it's hard to see how you can make much headway with that kind of framework. However, we are now into, I don't know how many weeks of particularly Pakistan, but I'm sure others trying to mediate here, and perhaps we're moving close to something that both sides can live with. However, at this stage, and with Trump making the kind of comments that he made yesterday about holding off for 2 or 3 days, again, it feels like an extraordinary time frame to try and reach a deal when there's no evidence that they're really making much progress.
Yeah. And Stuart, finally, how should we read the decision out of the US Treasury to extend the waiver on Russian oil?
Yeah, it's very interesting. So, yesterday we did have those reports out of Iran that there was potentially a similar sort of deal in the offing. That, of course, has subsequently been denied. But I think one of the key concerns here for the White House is to try and keep a lid on energy prices. Now, it's hard to say exactly what sparked this decision to extend the Russian waiver. But as we've spoken about repeatedly over the last couple of days, you had that very violent reaction in the bond market. And I think that's really what focused minds on trying to sustain enough supply to keep prices, energy prices, at a level where it's not going to spark the sort of rampant inflationary effect right across the world.
Yeah. Stuart, thank you so much. Stuart Livingstone-Wallace, Bloomberg's executive editor for Middle East, North Africa and Russia. Well, joining us now is Ozan Ozkural, founding and managing partner at Tanto Capital Partners. Ozan, good to have you with us. I guess this could go two ways, and it's binary. We could see a resumption of kinetic military action, or we could potentially see a breakthrough. How do you, as an investor, piece together what could be two very divergent outcomes?
Good morning, Jumana. I think our base case is that even if the hostilities cease, Iran has proved that it can exact pain in the region by playing an asymmetric warfare. And therefore, I think the new normal that we're meant to price is one where prolonged conflict is likely to continue, and a world where we're going to see the impact of inflation come through to the markets over the next months or so.
On the impact of inflation, certainly there are signs that it's beginning to creep up. We're seeing it in U.S. wholesale PPI and CPI. There are green shoots of inflation beginning to show up in markets, in the data, I should say, but less so in equity markets. At what point do you think equity markets are going to have to start paying closer attention?
I think this is a major problem. Equity markets should have paid closer attention to this when the hostilities started, but the market is trading quite narrow. What worries me is that the participation rate in trading has gone down, and therefore investors are, if you will, hiding behind the Max 7 and pretending that things are fine. Things are not fine because we're going to see the lag effect of this war. Even if the war stops today, it's going to be again a couple of weeks or months until the inflationary impact filters through to the real economy, and the market should really be trading this. Now, what we've seen over the past week and Friday in particular is that we don't necessarily have to have a single event for the sentiment to change, and that on its own is quite dangerous to me. I think we should be trading the current geopolitical and macroeconomic factors a little bit more carefully, Jumana.
Where do you see the opportunity to trade it, though? Because again, if you had bought $150 upside in oil, you'd be out of the money right now. If you had bought S&P puts, you'd be out of the money right now. So where is it likely to show up if you wanted to express that sustained inflation view? And I guess maybe bond yields is the answer.
I mean, bond yields look like they may be the answer, but I would not go long any bonds, especially the longer dated bonds. I don't see why any investor would want to put them in their portfolio, given so much uncertainty persists. The way I would want to play it is, again, look, if you take a step back, thematically, there are areas that we should place capital towards. Let's just take AI, for example. But the way to play the AI game, I don't think is necessarily going to be through the equity markets. We could focus on trying to play the infrastructure and the energy part of the AI game, which is actually much more grounded in reality and is likely to provide a longer-term hedge versus trying to go long again the Max 7 stocks. Commodities is quite dangerous. I think taking a step back and understanding who wins through this sort of a prolonged conflict is important. We're in a world where money market funds yield more than they did before. Granted, not as much as inflation perhaps, but maybe to have some liquidity and then go long innovation vis-a-vis the more infrastructure part of the innovation cycle is not a bad bet.
The other big geopolitical event last week, of course, was that high-stakes meeting between President Trump and Xi Jinping. And you fast forward a couple of days, and yes, we got a few agricultural deals, talks, reports of China buying those Boeing jets, a warning that came through from China on Taiwan. Would you say that this was a summit that moves the needle in terms of the global geopolitical power structure?
The meeting on its own wasn't a notable one from that perspective. But let's say one thing. This time next year, we'll be talking much more about Taiwan than we are doing right now. I think once the wars in both Europe and Middle East abates at some stage, what will remain is that strategic rivalry between US versus China, especially around semiconductor manufacturing, especially around Taiwan. Now, I don't think China really wants war. I think China's perspective is to try to kind of convince Taiwan that they belong within the Chinese framework. And obviously, it's not in the United States' interest to let that happen. And I don't see an obvious way to bridge that gap. Now, again, we're discussing US selling arms to Taiwan, which would be a deterrent of sorts. At the same time, we have witnessed through what's happening in Iran that you cannot bomb a country into submission necessarily, let alone an island. And therefore, given that if you will, the prize at play over here is semiconductor supremacy, I think we're going to hear a lot more about this, and I think we'll be talking about issues around Taiwan a lot more this time next year, Jumana.
Yeah, I think that probably is a fair assumption. Ozan Ozkural, Tanto Capital Partners Founder Managing Partner, thank you so much. Well, still ahead, we will talk rates and global markets with Dirk Willer, macro strategy and asset allocation global head at Citi. But up next, Russian President Vladimir Putin visits Beijing, hoping to exploit Middle East turmoil to get a deal on a gas pipeline. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Bersachi in London. Now, Vladimir Putin arrives in Beijing for talks with President Xi Jinping to exploit Middle East energy turmoil and deepen energy links with China. Bloomberg understands the Russian president is hoping China will be more flexible in negotiations on a contract for gas prices for the planned Power of Siberia 2 pipeline project. Let's bring in Bloomberg Chief North Asia correspondent Stephen Engel for more. Talk to us about the purpose of this trip and perhaps the economic incentive for the Russian president to be in Beijing right now.
Sure. I think this was a planned trip long ago before we knew the exact dates that Trump would be here. Of course, he was here last week, Thursday and Friday, but it's a stretch to say it was just a coincidence. I mean, I think the one mission is they can debrief each other, obviously, on what was discussed with Donald Trump. But really at the forefront and what will likely dominate the agenda for these talks tomorrow here at the Great Hall of the People will be what Vladimir Putin has wanted, sort of the sign-off, and Xi Jinping agreeing to the terms of gas contracts for that proposed and planned Power of Siberia 2 LNG pipeline that is really awaiting China's sign-off, if you will. They've been long negotiating about the length of contract, the size of deliveries, how much LNG to justify the extreme cost of this pipeline that will cut down through Siberia, through Mongolia, and into China. And that's something Xi Jinping has been trying to sort of drive down the price. He knows that Russia needs the Chinese, purchases of the LNG because of what's happened in Europe. That market has dried up for Russia. But on the same side, you can talk about what kind of leverage does Vladimir Putin have right now? Well, obviously, we've been talking about it consistently, and that is the war in Iran has driven up oil prices. All nations are looking for energy resilience and backups, and that might be a lever that Vladimir Putin is going to be pushing. I would guarantee that's going to be a lever he's going to be pulling to see if the appetite in Beijing right now to approve those contracts so we can get this across the line and get the pipeline built, whether there is appetite for that in Beijing right now.
Yeah, and of course, let's not forget overnight the U.S. Treasury actually extended the waiver on purchases of Russian oil. So he's got that as a tailwind. Is there anything else we can expect from this meeting, Stephen?
Well, there expected to be a number of different commercial deals. Keep in mind, really, China has been a main economic lifeline as the war in Ukraine enters a fifth year. Now, it's a strong but very uneven or unequal relationship on the commercial side. Simply, Russia needs China more than the other way around. If you look at exports from Russia to China, it's about 3.7%, or excuse me, China's exports to Russia, about 3.7%. 36% of Russia's external trade is with China. So it's an unequal relationship right now. And Vladimir Putin is bringing with him 5 deputy prime ministers, 8 ministers, a central bank governor, and also heads of large corporations. So we could see a deal flow come out of this. That is something that obviously, as the war in Ukraine really drags down on the Russian economy, it's showing more strain. As I said, the war in Ukraine enters a fifth year. So any kind of economic lifeline that Beijing can provide would be very much welcome to the Russians.
Stephen Engel, thank you so much for your reporting. 2 back-to-back summits, Bloomberg's chief North Asia correspondent. Now, coming up, Nvidia CEO tells Bloomberg he expects China to eventually allow the import of artificial intelligence chips from the U.S. We'll have that exclusive interview next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Bersecci in London this week. Nvidia CEO Jensen Huang says semiconductor demand in China is incredible, and he expects authorities there to eventually allow the import of AI chips from the U.S. Huang was a last-minute addition to a delegation of business leaders who traveled to Beijing for President Trump's summit with Xi Jinping. He spoke to us exclusively in Las Vegas alongside Dell CEO Michael Dell.
The president wants America to win everywhere. Right. The president wants America to lead the AI revolution. And so H200s are licensed to sell to China. The Chinese government has to decide how much of their local market do they want to protect and how much of their local market do they want to expand with more AI capacity. My sense is that the demand in China is so incredible. Just like it is here, agentic AI is also making enormous progress there. My sense is that over time, the market will open. President Xi was very clear that he wants China to be an even wider open market. Premier Li Qiang was very straightforward and to explain very eloquently that China will be an open market. So I'm looking forward to China being a more open market.
To clarify, Jesse, you were able to meet with those officials directly to discuss whether or not you can sell to those Chinese tech companies.
I didn't discuss directly with them about H200.
Right.
I was there to represent the United States, and I was honored to do so. I was there to support President Trump, and really glad to do so. But that was really the focus of my trip. President Trump had some conversations with the leaders, and I'm looking forward to what they decide.
Michael, you did not go to China, but I think what's interesting is you are a member of the President's Council of Advisors for Science and Technology, as is Jensen. Your net conclusion on whether or not China will become open to American technology companies to do business there?
You know, we have a business in China. Obviously, we comply with all the restrictions and various controls that are in place. But I hope that there's more economic collaboration between the United States and China. That ultimately is what will lead to greater outcomes and prosperity for everyone, and a greater likelihood of a successful relationship between the countries and around the world.
Nvidia CEO Jensen Huang and Dell CEO Michael Dell speaking exclusively to Bloomberg tech co-anchor Ed Ludlow. Now for a look at some of the other stories we're following today. Iran's semi-official Fars news agency says Tehran has started a Bitcoin-backed insurance service for Iranian shipping companies that want to transit the Strait of Hormuz. The insurance service, dubbed Hormuz Safe, provides Iranian shipping companies and cargo owners with fast, verifiable digital insurance with payments settled in Bitcoin. Bloomberg has learned UBS has lost several senior wealth management bankers in the Middle East less than 2 years after hiring them. The departures highlight an intense race for banking talent in the region, which was becoming a major hub for the world's ultra-wealthy before the Iran war began. The UAE in particular lured the world's ultra-wealthy thanks to a favorable tax regime. Coming up, a new Ebola outbreak in DRC and Uganda is raising fears the virus could prove harder to contain. More details next. This is Bloomberg. Good morning. This is Horizon's Middle East and Africa, our top stories this morning. Paused for now, President Trump says he's calling off a planned strike on Iran, citing appeals from Persian Gulf allies. But he warns the U.S. remains prepared to attack if a deal is not reached. Oil and stocks decline after Trump's comments. Investors' worries about lack of progress in Iran, keeping inflation concerns front and center. And the U.S. is now stepping up its response to the Ebola outbreak after a missionary tested positive for the virus in the DRC. We are live in Johannesburg with the latest. It's just gone 8:30 a.m. across the Emirates, 5:30 a.m. over here in the UK. I'm Joanna Versace in London. Market's not really sure how to read the latest news coming out of President Trump that they've held off on attacks on Iran. It could be a good thing or a negative thing, and so far there is no full resolution. Abid Abu Hamad is in our Dubai studio and ready to break it down for us. Abid, how are markets reacting today?
A sea of red, Jumana. You can see the screen behind me. U.S. futures 0.3 down. Asian equities already trading 0.7% down. Now, if you remember last week when it comes to the U.S., we were talking about the return of the AI trade and AI investments. And now, as you mentioned, investors turn back their attention to Iran, to President Trump's comments about an imminent attack against Iran that did not happen after he was persuaded by Persian Gulf officials. So markets not really really understanding what to read out of that. Another interesting trend that we're seeing very specific to the United States is this rotation that we're seeing outside of hardware and into software. That's a flip of the picture that has started since the start of the year, something that is pointed out by our strategists. Now, when it comes to Asian equities, led down by the Kospi yet again, it was falling as much as 4% in South Korea earlier, so that is weighing on the overall index. Now, when it comes to Brent prices, these are a reflection of the comments from President Trump and again, the attack that was held off against Iran. 2% lower this morning when it comes to Brent crude. We continue to monitor bonds across the world, but when it comes to the yields on the 10-year notes in the United States, not doing much today. Now, remember, the 10-year yields last week had their biggest gain in about a year, driving down bonds. We continue to keep an eye on bonds in Australia and New Zealand still trading, and also JGBs. Now, when I speak about JGBs, we flip the board and we take a look at how yields are doing. Now, how yields are doing in Japan is a story from yesterday, but it continues into today. The 30-year notes are the highest since 1999, Jumana. The 10-year notes on the yield front are the highest since 1996. And that brings me to data that came out this morning from Japan, and it is about the first quarter GDP that came out much higher than expected. 2.1% for the first 3 months of the year, not really reflecting the inflationary risks or the full extent of the inflationary risks from the Mideast war, and that is higher than consensus. It was at 1.7, so really brings into perspective that notion of the BOJ hiking rates. Now, our Bloomberg economics team is still expecting a rate hike on the base rate for Japan, but they say that the likelihood of that is still very much uncertain as we continue to monitor those inflation concerns coming from the region and how long the war will continue or the ceasefire will hold, Jumana.
Abir, thank you so much. Abir Abu Hamad in Dubai. Now, the U.S. is stepping up its response to the Ebola outbreak after a missionary tested positive for the virus in the DRC. Washington has now imposed new travel restrictions, and the CDC is expanding its emergency response as concerns grow over the spread of the rare strain. Our chief Africa correspondent, Jennifer Zabazaja, joins us from Johannesburg. Jen, just talk us through how serious the Ebola outbreak is right now.
Well, Jumana, by the WHO standards, it's quite serious. And that is just if you take a look at what we are hearing from the WHO and also from a number of other agencies, largely because there is a risk of international spread. And there's also a need for coordinated response. And that's really what we've been seeing over the past few days since we did get that emergency declaration by the WHO. And really, that is because this new strain of the Ebola virus is one that many people fear has gone undetected for a number of weeks, and potentially one that could have been gone undetected through borders where a lot of trading goes on. There's quite a bit of mining activity that goes on. And so at this point in time, Bloomberg reporting is suggesting that about 350 suspected cases have taken place in the DRC, and just about 91 deaths. And really the concern is how wide-ranging is this disease? And really, considering we don't have a vaccine for this current strain, what are the protection measures that authorities are going to be putting into place at this point?
You know, you mentioned that there was a certain strain of this that was spreading undetected for weeks. And I just wonder how the cuts to U.S. foreign aid have affected the response capacity on the ground here. Could the strain have been detected sooner had there not been those cuts?
That has come up quite extensively, Jumana, and the discussions as we've been talking about this crisis as it's unfolded, because in previous outbreaks, a lot of the funding that has come from the U.S. and USAID in particular has helped in terms of detection and also deploying a vaccination. Now that we have, of course, seen the Trump administration and the U.S. scaling back significantly last year on that, the concern is that potentially we are going to see the the attacking of this virus a lot differently than we've seen in the past. I should point out, though, that what we did hear from the WHO over the weekend, this emergency declaration, is meant to spur donor agencies and also countries into action. We did hear from the State Department and the U.S. CDC on Monday saying that they are providing about $13 million in foreign aid. So we are seeing some sort of foreign assistance that is stepping in. But many people are, again, wondering what are the effects of this USAID cuts, especially because we've been reporting on some of the cuts having an effect on crisis zones, which, of course, is the DRC in this area in particular, and this having a compounding effect on weakening infrastructure and the response that a lot of these agencies and also workers in the region have had to deal with, just given the scaling back of funding and support that they've had over the past year.
Jen, thank you so much for the crucial reporting. Jennifer Zawazaja, our Chief Africa Correspondent in Johannesburg. Well, Equity Bank is ramping up efforts to double its regional footprint as the lender looks to diversify revenues. The CEO, James Mwangi, tells Bloomberg's Jennifer Zawazaja how East Africa's biggest bank is looking to facilitate free trade in Africa.
At the moment, we are in 5 countries, and we have a vision of being in 15 countries by 2030. Simply because we are a leader and a champion of financial inclusion. To date, we have 23 million customers, and we have an ambition using technology, and particularly digital public infrastructure and digital financial services, to reach 100 million customers by 2030.
Have you identified those countries that you want to add, outside of the ones that have been named? I think it's Mozambique, Zambia.
It is true we are in DRC, Rwanda, Uganda, South Sudan, Tanzania, Kenya, and Ethiopia. But those don't constitute Africa. They're just part of Africa, East and Central Africa. So the ambition is to ensure we're in the whole of Africa. We are facilitating the African continent of free trade area trade, and that will require us to have capability. We are approaching that in a twin approach. The first one is entering countries, and we have earmarked Ethiopia, Zambia, Mozambique, and Angola in the medium and short and medium term, and then we could pick another 5 countries.
Have you identified those other 5?
They will be part of the remaining countries on the African continent. It may be another cluster, but as you can see, we have approached this from trade routes. So we prioritize on where is the highest volume of trade from where we are. At the moment, the first huge trade traffic was with Uganda. Then we went to Tanzania. Then we went to South Sudan. Then DRC became a huge corridor. We're now realizing that the hottest corridor is the Lobito corridor between DRC, Angola, Zambia, and Mozambique. So that is how we evaluate. So as African trade takes shape, it will give us the priority. But the ultimate objective is to be an African bank banking the entire Africa.
That was Equity Bank CEO James Mwangi speaking to Bloomberg's Jennifer Zawazaja. Now for a look at some of the other stories we're following. Protests over rising fuel prices turned deadly in Kenya, with 4 people killed and dozens injured. The unrest disrupted transport across major cities after bus and taxi operators launched a strike over soaring diesel and gasoline costs. Ghana wants large gold mines to sell at least 30% of their output to the central bank to support local refining and boost forex reserves. The government says the gold would be purchased in unrefined form to help expand domestic processing and create jobs. Officials say miners have agreed in principle to the proposal, though talks on pricing are still ongoing. Now, coming up, our next guest says global rates are breaking out of key ranges as the Hormuz standoff fuels rising inflation risks. More with Citi's global head of macro strategy and asset allocation, Dirk Willer, next. This is Bloomberg. Traders are turning risk off as concerns around Iran linger, even after President Trump says he's holding off on fresh strikes on the Islamic Republic. Markets are facing a key test as bond yields remain under pressure due to high oil prices, increasing bets that global central banks will keep rates higher for longer. Joining us now is Dirk Willer, Global Head of Macro Strategy and Asset Allocation at Citi. He is also the author of the book, Trading Global Macro Markets. Interesting time to be putting out a book about trading global macro markets. Maybe we can talk about that later. But Dirk, let me just start off by asking you about the move that everyone's been talking about in the last few days, and that is the rise in fixed income in bond yields. And I wonder whether it is actually possible at this point, say specifically talking about 10-year USD, to come up with a fair value. We're sitting at 4.6% now. Where should that 10-year US Treasury be in light of the various inflation risks to come down the track?
Yeah, no, very good question. Thanks for having me. I would say fair value in treasuries depends, of course, a lot about your Fed call, right? And the Fed call became really quite tricky because, as you know, Chair Walsh came in with a strong view that AI will be disinflationary and that the Fed should not react to short-term data prints and rather focus on that big picture. The problem is, of course, at this stage, there's very, very little evidence that there is a sufficient job destruction from AI to justify any action by the Fed on that front. So with this big uncertainty on the front end, that also means fair value at the back end is difficult to ascertain. And so the market right now is, in a sense, pushing yields higher. And I do think we are at some crucial levels that not so long ago people would have thought should be the ceiling for yields. But given this uncertainty at the front end on the Fed reaction, these levels could be breaking. And then I do think if that were to happen, there would potentially be some follow-through. So the curve really could steepen further, even or especially maybe if the market doubts that the Fed can react on the hawkish side.
Yeah, let me just ask you, because again, there are so many different narratives in the market right now. There's the sort of energy crunch going on. There's the rise in fixed income yields, which is related to that. And then you've got the AI mania that's showing up in equity space, particularly in the US and in Asia. At what point do rising bond yields start impacting the rally that we've seen in equities?
Yeah. Another very good question. I think it will take a while. So what is true is that whenever we build these equity bubbles, bond yields rise, right? Because there is a positive wealth effect, there's a strong growth effect, and rates are naturally going up. But remember, in 2000, it took 175 basis points of Fed hikes, and it took the Fed to withdraw major liquidity in January of 2000, a liquidity that they had really pushed into the market to fight the risk of the Y2K bug. And so it was a combination of major liquidity withdrawals together with an aggressive hiking cycle that in the end was too much for the equity market. So now you, of course, never know which hike is the one that pushes the market over. But certainly at this stage, we still seem to be fairly far away from such a situation. So, and by the way, that is actually a chapter in the book that you kindly mentioned where we discuss what rates price action really undermines equities. And you find it really has to be fairly aggressive moves before that tends to happen. So we don't think that the rates price action will already be the end of this bull market. But given how overbought the market is, that doesn't mean it can't go sideways for a while. But we think we need meaningfully higher rates before the equity market would have basically the end of the bull market at this stage.
Yeah, there is an article in the Wall Street Journal today. The title is "The Economy Kevin Walsh is Inheriting is Not the One He Wanted." And certainly, what we are seeing is increasingly other members of the Fed, the FOMC, are getting slightly concerned about the inflation risk to come down the track. What do you think this means for an incoming Fed chief who, was nominated by the president with the view that, maybe he'd start bringing about an easing cycle, but in fact, the conditions on the ground have changed significantly in the last couple of months?
It's a very difficult situation, for sure. I mean, I would say at this stage, probably the best outcome he can hope for is that we get maybe still some negative seasonality in the labor market, which is almost the last argument left for focusing more on the dovish side. And then at some stage, maybe it is true that these AI-related job cuts will hit the labor market hard, and then that would maybe down the road at some stage open the door for cuts. But certainly at this stage, there are not many arguments that Chair Walsh can use to convince the rest of the committee to lean on the dovish side. And we already saw it in the last meeting, of course, the last Powell meeting. We had those dissents that really could have been, in some sense, you could have just adjusted the wording of the statement slightly and maybe avoid these dissents. But I think it was a little bit sending a message to the incoming chair. Listen, there are some questions which way the Fed should be leaning. And so you have the combination of yes, a stronger labor market than we thought. The last NFP print was a big deal. I think it was the first time we had two positive NFP prints in a row for quite some time. They were coming in both above 100K, and no matter what you think the break-even rate is, it's certainly above that, suggesting a decent labor market. And of course, we have no Iran deal yet. So the combination means, Walsh will have to work hard to just not hike rather than cut in the short term.
Yeah. Dirk, really good to have you with us. Thank you so much for joining our show. Dirk Willer, Global Head of Macro Strategy and Asset Allocation at Citi. Now, coming up, Israel's economy is showing mounting signs of strain from the ongoing conflicts in the region. We'll discuss that next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Bersetchi in London this week. Israel's economy is showing mounting signs of strain from the ongoing conflicts in the region. New data shows the economy contracted more than expected in the first quarter as the fallout from the Iran war disrupted businesses and consumer activity. Joining us now is Ziad Dawood, Chief Emerging Markets Economist at Bloomberg Economics. I remember when the IMF put out their updated economic forecast for the region, Israel actually stood out positively versus the rest of the countries in the region. But of course, now the latest figure is suggesting that there has been quite a deal of economic damage. I mean, no surprise there on back of the war. Just talk us through the impact the war has had on the Israeli economy.
Sure. So the war has had an impact on the economy. Before October 2023, Israel used to grow at 4% a year. After October 2023, that 4% slowed to 1%. That's a significant slowdown. Over 10 quarters, that accumulated to about a 7% of a gap between where the Israeli economy is and where it could have been had the wars never happened. And that gap is significant. Now, of course, if you look at financial markets, you don't see that. Stock prices are surging, the currency is rallying, but if you look at economic data in terms of the growth slowdown, if you look at the consensus forecast and how it's continuously revised down whenever there is war, there's a sort of a disconnect between financial markets and real economic data.
And how dependent is the recovery of the economy on the current ceasefires actually being maintained? I mean, these are very tenuous ceasefires with Iran, with Gaza, and in Lebanon, and in southern Lebanon, which clearly has been very volatile as of late.
Yeah, if you think about if Israel's economy were to recover to its pre-war or pre-October 2023 path, I think it needs two conditions. The first one is that the wars need to end, and for that ceasefires are important in Gaza, in Lebanon, but also in Iran. And the second condition is that the state of war that the country has been in for the past 2.5 years need not have caused lasting damage. And that assumption could happen, but it's also challenged by a number of factors. There's a risk of outward migration, there's a risk of declining foreign direct investment, and there is a ballooning defense budget. And if you spend more on defense, you spend less on productive activities like health and education. But ceasefires are crucial. No lasting damage is crucial for Israel to return to its pre-war path.
Ziad, thank you so much. Ziad Dawood, Bloomberg Economics Chief Emerging Markets Economist. Thank you. Well, so much of the talk over the last couple of days has been about the rise in bond yields, but of course the catalyst for rising bond yields has been the inflation shock emanating from this part of the world, from not London where I am today, but of course the Middle East. And what we did get yesterday was a confirmation from President Trump that they are looking to hold off on any imminent attacks on Iran with the view that they're going to give negotiations a chance. Now, markets have not really been clear on how to read this. Here in front of me, you have 10-year yields moving moderately higher this morning, about 1.5 basis points. 10-year yields sitting at 4.6, 2-year just above 4%. So worth bearing in mind there that the market is accounting for a series of now rate hikes out of the Fed. 2-year yields higher, obviously, than the Fed base rates, which indicates that the markets are looking ahead to the potential for rate hikes out of the new incoming Fed chair, that is Kevin Warsh. A ceremony will be held for him on Friday. But beyond that, also just want to flag oil and the price action that we're seeing there this morning. The U.S. Treasury have announced an extension of the waiver on Iranian oil, so that is helping to cap some of the price movements this morning. Just shy of $110 is where Brent is sitting at, so down about 2.1%, and then WTI at $107 at 1.5% weaker on the session. But that is it for Horizons Middle East and Africa. I'm Joanna Versace in London. Stay with us for Daybreak Europe.